perfect chart pattern. You know the one. Your indicators are screaming buy, everything looks perfect. But the second you get in, the price just collapses, hits your stop loss, and then, and only then, does it rocket to the moon without you. Yeah, that's not just bad luck. You were just used as fuel by a much larger player. Today, we're going to pull back the curtain and show you the unseen hand that really moves the market. I mean, this exact scenario has to be one of the most frustrating things for any trader. You follow all the textbook rules, you spot a classic bull flag or a perfect double bottom, and you place your trade feeling pretty confident. Then bam! It's like the market personally hunts down your stop loss before reversing and proving your original idea was right all along. If that sounds familiar, it's because you're seeing the effect, but you're not seeing the cause. What you're experiencing is something called a stop hunt, and this right here is a perfect picture of it. It's a totally engineered move where these huge institutions intentionally push the price just past a key level of support or resistance. And why do they do it?
Well, it's to trigger all those stop-loss orders that retail traders, like us, have placed there. Your sell stop becomes the exact liquidity they need to fill their massive buy orders at a much better price.
Okay, so let's dive into this, because once you understand the why, you can finally start to avoid the trap. It really all comes down to one fundamental difference between how we trade and how the big money has to operate. And this is the key concept right here: institutional order flow. Think about it. While our trades are like little streams, institutional money is a full-on tidal wave. We're talking about hedge funds, big banks, trying to move billions of dollars. They can't just go and click the market buy button. If they did that, the price would just explode against them and they'd get a terrible fill. Their biggest challenge isn't figuring out which way the market is going, it's finding enough volume to get in. So where do they find all this liquidity? Well, this slide shows us exactly where. See, every single time a trader sets a stop loss just below a support level, like a double bottom, they're helping to create what's called a liquidity pool. It's basically a guaranteed pocket of sell orders just sitting there waiting to be hit. For a massive institution that needs to buy, that pool is the most efficient place on the map to fill their huge positions. So they push the price down, soak up all those sell orders, and then, and only then, do they let the market go. So here's the crucial point. We are playing two completely different games. Retail traders like us, we're focused on trying to predict which way the price will go so we can make a profit. Institutions, on the other hand, are focused on a logistics problem. How do we get enormous orders filled without causing a massive price move against ourselves? These stop hunts, they aren't always malicious. It's just a functional necessity for the market's biggest players. Okay, so if our standard charts don't really show us what's going on behind the scenes, how do we start to see it? Well, let's talk about the tools the pros used to decode these institutional footprints before they even happen. Your standard candlestick chart is basically a history book, right? It shows you the outcome of battles that have already been fought. But what it shows you is just the tip of the iceberg. It can't show you the armies gathering in real time. It can't show you the huge hidden orders or where liquidity is building up or suddenly disappearing. It definitely can't show you the raw aggression of buyers versus sellers at a specific price. To see that, you have to look at order flow. And these professional tools, they give you that edge by making the invisible visible. A heat map, for instance, shows you the entire order book, live. You can literally see where massive walls of limit orders are stacked up before the price even gets close. Then you have a footprint chart, which is incredible. It cracks open every candle and shows you the exact volume that traded on the buy side versus the sell side. It's like having X-ray vision into the market. But here's the good news. You don't necessarily need a bunch of expensive software to start thinking like an institution. There's a whole methodology out there that helps you spot their footprints right on a plain price chart. So let's look at a practical toolkit to start trading alongside the smart money. This is where Smart Money Concepts, or SMC, comes into play. Basically, SMC is a way of reading price action that just throws out all the old lagging indicators. Instead, the entire focus is on identifying the trail, the footprints left behind by all that institutional order flow. It's about seeing the market as a story of liquidity being built, then swept, and then purposefully delivered to the next logical area. And one of the most important footprints you can learn to spot is the fair value gap, or FVG. This image shows it perfectly. See, when institutions move the market really aggressively in one direction, they often leave behind these little pockets of price inefficiency, a gap where trading wasn't really balanced. Well, that gap acts like a magnet. The market often feels this need to go back and trade inside of it to sort of rebalance things before continuing its move. And that right there is a massive clue.
So here's a simple little playbook you can start looking for. First, find a sharp, powerful price move that breaks a previous high or low. We call that displacement. Second, look inside that big, powerful move for the fair value gap it created. Then, third, and this is the key, instead of chasing the price, you anticipate the retest. You patiently wait for the price to pull back into that FEG because that often gives you a much higher probability entry than just buying a breakout.
But look, even with the best tools, the best strategies, none of it matters without the final and, honestly, the most important piece of the entire puzzle, a truly professional mindset. This quote from proprietary trading firm founder Mike Bellafiore, it changes everything. Just think about that for a second. A losing trade can be a good trade. How? Why? Because a good trade isn't defined by whether it made money or not. It's defined by the process. Did you follow your plan? Was your logic sound? If the answer is yes, then you took a good trade, period. P&L doesn't matter. And this brings us to the fundamental shift that every single trader needs to make. The amateur trader is outcome-focused. Their happiness, their mood, it all goes up and down with their P&L. It's just an emotional roller coaster of fear and greed. But the professional, they are process-focused. They obsess over their preparation, their execution, because they know that if the process is solid, the positive results will just naturally follow over the long run. And according to Bellafiore, this professional process is built on 7 fundamentals. It has nothing to do with a magic indicator. It's about doing the unglamorous but absolutely essential work. It's the proper preparation before the market even opens. It's the hard work of daily analysis. It's having the patience to wait for your A+ setup, having a detailed plan for when it shows up, and then having the discipline to actually follow that plan. And finally, it's about committing to getting better through communication with other traders and by constantly replaying important trades to learn from every single win and every single loss. So the question I want to leave you with is this. Are you ready to make that shift? Are you ready to stop chasing patterns and getting caught in those liquidity traps and instead start trading with the tide by understanding why the market truly moves and by building a professional process that can actually stand the test of time?